So market commentators are saying it's really a cocktail of factors which led to the overall 5% profit dip, loan impairments, rising cost as a whole, and of course the weaker currency here in South Africa. Is that a fair reflection?
Now, loan impairments came off 19%. Costs were up 1.9%. They were all as a consequence of some acquisitions that we made. And the rand had an effect of 15%. So if you turn it around, if we reported adjusted earnings per share in rands, they would have been up by 9.8%. And adjusted earnings would have been up by 20% or 19%.
So let's break it down by the regions, because we've seen, growth in these South African operations. Talk to us about how well South Africa is doing relative to the UK and Australia right now.
South Africa in home currency was up by just over 6% in operating profit. Australia was a big turnaround from a loss to a profit, and that would have been a swing of about 30 odd million pounds, even a bit more. And the UK was marginally down in home currency, down by a few million pounds. So overall, across our geographies, the performance was reasonable, with a big turnaround in Australia. The reason why the earnings were down slightly was obviously the pound exchange rate had a big effect on the translation of the South African profits. So instead of being up 6%, they were down 10% in sterling.
Now, of course,
so that is really a summary of the results.
When it comes to your acquisition in the UK, the Evolution Group, you bought it for £233 million. It was said to bring on, help bring on wealthier clients, help increase recurring income. How's the integration going on that end? And what kind of timeline can you give shareholders when it comes to really being able to see the fruits of that acquisition coming to bear?
The integration was really by and large complete at the end of August. So the Williams de Bruin name no longer exists, and it's now called Investec Wealth and Investments. All the branches' names were changed, and they were realigned to look and feel like Investec. All the admin platforms were moved onto the Investec platforms on that day, on the 30th of August, and they now run on the Investec platforms under the Investec brand. And that's quite good progress. Now it's a question of making sure there's proper alignment between clients and staff and all those things. That's the next phase of the job. So I think very good progress thus far, but you'll only really see the effect of it on earnings in that business in the second half next year.
When it comes to top-line earnings right now, one of the comments coming through is that they're worried about the flat growth you're seeing. Just looking at the net income number, coming in at £168.5 million, it was £179 million the previous year. Should we read into the drop-off there? Is there any way to get that up again?
Well, that was, firstly, if you look at it as an adjusted earnings number where you take out one-offs or costs relating to acquisitions, then this year's number of £168 million relates to last year's of £162 million. And then the rand had a big impact on that. If the rand depreciated by 15%. So if you eliminated the effect of the rand, the numbers were up quite strongly.
Stephen, talk to us about your comments right now when it comes to the eurozone crisis, because you've said it's helped realign the business and of course made you more resilient going forward. Could you elaborate on that for us?
Well, I think the euro crisis is still there in some form or other. It's moderating, and I think it's getting a lot better, and I think that it will sort itself out, but it's a muddling through type process. I think it was a financial crisis that really caused us to realign our business model, and where banking has changed probably for decades to come. And that's what we had to do. And we reorientated ourselves more against non-capital intensive revenues. Asset management has built up very well. We focused on building wealth and investments at the same time, and we've had to reshape our banking businesses quite significantly.
When it comes to the second half of the year, you talk about, perhaps improvements in the eurozone crisis right now, signals there, but then, can you hear me, Stephen? seems like we have a bit of a problem with that line. Stephen, can you hear me? Well, my next question was going to be on the return on equity. And of course, this is really the key question for the market right now. I mean, sitting at 9.3% here in South Africa, that of course the ROE for Investec, well below South African peers. Stephen has come out and said that is a big focus going forward. So we're trying to get some clarity when it comes to what they are going to do to improve that. Company very much saying that is a big focus. 9.3% is far below even Standard Bank, which has said, that is a big focus for them as well. I think we're going to get Stephen's line back up and running, but we're also talking about cutting costs. That has been an issue for some of the market commentators here in South Africa. Do they need to cut costs further off the system? We had Standard Bank announcing they're cutting their staff in London by 15%. So feeling the pressure when it comes to that operation, perhaps specific to Standard Bank. And I suppose that is going to be my next question to Stephen. Stephen, I hope you can hear me now. So as I was saying, Standard Bank has been cutting back staff in the UK right now. Are there plans right now to cut back on your operations when it comes to staff expenses in the UK?
We've got a totally different model to Standard Bank in the UK. We have a strong domestic franchise. Standard Bank used the UK as a platform for their global emerging market franchise. Our main headcount would be, we have a lot of people in asset management, which is a very successful business. We have a lot of people in wealth management, which again is a successful business. And we know in the banking business, there's a whole lot of areas that, in areas we did cut back staff over the last few years, but then the other areas that we're building up. So I don't think the issues around cutting back on staff. I think the issues around when does the world get better and how long does it take to clear legacy books. But you are seeing, you're seeing a big improvement on the global front, and it's just a question of continue to navigate the storm. We have a lot of surplus liquidity, and that costs us a lot of money. Interest rates, again, are very low. That costs us a lot of money. And at a point in time, we will manage down the cost of the liquidity and manage down some of the surplus liquidity. And you'll start seeing a fairly big improvement.
When it comes to that liquidity, why are you keeping so much liquidity within the system right now? Is it because of regulation? Is it because as a buffer?
I think first of all, if you understand, we went through a very tough crisis, which South Africa never really went through in South Africa. We are a bank that survived a crisis on our own without any help from anybody. If you looked at the UK, 6 or 7 out of the top 11 banks actually ran into difficulty and had to get support from their governments. We weren't taking any chances, so we built up our deposit franchise, and until such time as the world settled down, we held excess liquidity. We see that it's starting to settle down, and we probably can hold a little bit less liquidity going forward, and that's something we have to monitor depending on how some of the macro things play out. You still got fiscal cliff risk, you still got euro risk, you've still got 1 or 2 other risks in the Middle East, and you've still got China growth risks on the horizon. So we'd rather not risk the farm and have a little bit less profit and a little bit less ROE at this point in time than take unnecessary risks and risk our franchise. So we have sat with a lot of cash because that's ensured that we will survive very difficult times. But obviously, as times improve, we can start relaxing on that a bit.
And of course, you mentioned the ROE factor sitting at 9.3%. You've stated it's a focus area right now. You've stated why, of course, it is low. But what are your plans right now to improve it? Do you have any target levels in sight?
Our overall ROE was 10.2% for the group. We said that in the bank, it's 9 point something, I don't remember the exact number, and that's obviously what we have to improve, and we have to get that back up into the, I would say, the mid-teens. Now, that will happen over time as conditions improve, as impairments run off, and as activity levels return to normal. So we're reasonably comfortable that we can improve those returns quite substantially, but you have to remember what we have come through. Our ROE in South Africa is 14.5% after tax. That was much higher. It was right in the mid-20s to late 20s at a point in time. Now that will also track up back to probably between 15 and 20, But the days of very high ROEs are gone. We have to hold significantly more capital as a bank, and we can't leverage like banks would have used to leverage.